Hi, I'm Jim Jackson, and I am bonding over bonds with Kevin Kaase. Kevin, strong returns for the bond market in the second quarter. So we saw positive returns for corporates, high yield munis, pretty much across the board.
Yeah, Jim. We also saw the Treasury curve flatten, where longer rates declined, and while short-term rates actually increased.
I would also note as well that credit spreads, both in high yield and IG, tightened during the quarter as well. It's hard to believe that we're halfway through 2021, and it's probably worth offering our outlook on the second half of the year.
Sure. Well, I definitely believe that the turning point in the credit markets was the June FOMC meeting, where the Feds turned more hawkish. Credit markets have definitely benefited greatly from the Fed's easing measures, both QE as well as low rates. It's driven strong demand globally from investors. Now we're coming into a territory where credit spreads with their higher valuations are becoming much more vulnerable to the timing of the Fed and what they end up doing, whether they raise interest rates or start to taper.
Sure. I would note that credit spreads are at or near all-time tights. Now, historically, this has led to mixed returns going forward. However, we think that for the rest of this year, that carry or the income that is generated from your bond holdings will drive returns for three reasons. One is that corporate fundamentals are improving. The economy is growing, and the global search for yield goes on. As we sit here today, almost 20% of the global ag still has a negative yield.
No, I definitely agree with you. One thing I'd like to add is that central banks here are very accommodative or supporting what you're saying. Also, I'd like to add is that at this time we're expecting a slight slowdown in new issuance, which this is versus last year, which creates a technical in the marketplace. And what I mean by that is supply is having a difficult time keeping up with demand. So there's too much money chasing too few bonds right now.
Yes, and I think the final point that we would like to make is that spread dispersion within the credit markets is very low. We think this provides an opportunity for active management to outperform. So thank you, Kevin, and thank you as we bond over bonds.